Wait, I got a better one.
Okay, I'm going to start out laughing here. Because we always start with a clap.
I love the clap. The clapping's my favorite part, and I get really excited, and sometimes it's very loud.
Yes.
And abrasive, and then sometimes I miss a little bit, and so I just clapped. You guys didn't hear that part, but it was we can't recover.
We start with a clap so that it just sets the
tone. Yeah. Welcome.
Welcome to Buy the House, Build the Home.
Welcome.
Today we have a special guest. Do you want to introduce Mendy?
I will. I'm going to let you introduce yourself, but she is fantastic. We've done so many deals together. Mendy Webster with First United. I'm going to let you tell a little bit about yourself, how long you've been in the business. But if you're a client of mine or have been, I oftentimes send Mendy your way to help you get set up with being pre-qualified for a home loan, just exploring your options of, what you need to do to take next steps. So without further ado, the infamous Mendy Webster, ladies and gentlemen.
Well, hello, I'm Mendy Webster. I'm with First United Mortgage, and I have been a loan officer for over 20 years, so I've seen a lot of things.
Aren't you like 32?
Oh, yes.
Started very young.
Yes, of course.
Child labor.
20 years, though. That's impressive.
Yeah. It's a funny story because I started out, I was going to become a realtor.
Oh.
And I went to the school, took all the classes, and I had one class left. And then I had to take the test. And I ran into one of my sorority sisters, so crazy. And she was like, "What are you doing?" I said, "Well, I'm going to real estate school." And she goes, "Hey, you probably should talk to my husband. He's in the mortgage business." And he called me that night and asked me to meet him and his broker. And I met them for lunch. And they basically sold me that I was more suited for a mortgage. It just fit my lifestyle a little bit better at the time because, I had a little one. And and he said, "Hey, if you're in the mortgage business and people come to you and they're wanting to give you their, personal information, they're serious." He said, "There's not a lot of tire kickers." And, just basically sold me on it. But so here I am all these years
20 years later.
Never finished my real estate license.
It's not for everyone.
No, it's not. It's not for the faint at heart.
People think, "Oh, yeah, you just want to hop on the bandwagon." But
yeah.
But you are very good at what you do.
Well,
I always, whenever I'm talking to clients, I always tell people, Mendy is full of integrity. She's not going to look at you as a dollar sign, try to get you to sign up for something that's biting off more than you can chew from a payment standpoint. You are timely, you communicate. And the way I actually found Mendy was I was representing the seller.
Yeah.
And the buyer's agent and then the lenders all involved. And so I was getting all these updates. And Mendy would be like, "We are on track to close on time." And we were on track to close on time. And she would just communicate. Yeah. And I had been working with another lender and it was difficult. There was a couple issues that were popping up. And so I probably a month after that transaction closed, I reached out to that realtor and I'm like, "Who was that lender that you were working with?"
I need to know.
She was on the ball.
Yeah.
She was responsive. And so it's rare. I've worked with a lot of them and having a good lender in your corner makes a really big difference.
Well, I appreciate that. I really care about my clients. It's a really big deal to me. I feel like I really get to know them and I want them to make the right decision. This is a really big deal.
Yeah.
And probably the most money they'll ever spend on anything.
Yeah.
I want them to know what they're doing. I want them to understand it. I mean, it can be a phenomenal opportunity for them, but that doesn't mean that somebody's really holding their hand and explaining everything to them.
Yeah.
But then on the communication side, it just really bothers me if somebody's not, we're all in this transaction together. You've got title and the listing agent, the buyer's agent, the buyers.
Pieces,
And I want them to know what's going on, where we are. So nobody has to call me and say, "Hey, are we really closing next week? I haven't heard from you."
I haven't heard from you. What's
me,
happening?
So,
yeah. I love it. Well, you're fantastic at what you do. We're so happy to have you on.
Thank you. You're
So
fantastic too.
Well, thank you.
I remember I got introduced to you through Betty when we were buying our first home. And my husband and I thought that we couldn't buy a home because of our income at that time. And I reached out to you, and I think that same day you got back to me, you're like, "You're qualified for this." And I was like, "Huh?" What? And I just remember you taking such thorough care during that first transaction and helping me understand, like, oh, well, you qualify for this, but if you're wanting your payment at this, you shouldn't go above this number. And then the second house, the one we're currently sitting in, that was a spur of the moment. I called you on the weekend. I was like, I need to know. These are all the numbers. And you were like, okay, we can make this happen.
And we
if
did.
you do these exact things. And here we are.
Yeah.
So, yeah, I just want to affirm what Betty is saying and what you're saying even about yourself, is that at the end of the day, people aren't a number to you. Like, you're really in it for their best interests. And I saw you, like, battle for something that I wanted as well.
Well,
I just
it's a
love
big deal
that,
to me.
so.
I mean, I want people to walk away from their experience thinking maybe not the easiest thing they ever did, but that I at least cared about what was going on with them, and that I tried my best. I mean, I really want to try my best all the time, because it's just too important.
Yeah.
And, you know, if it's not the best thing for them, if, you know, they come to me and they have 50 cents in their bank account and they want to
like, well.
double their mortgage payment, I mean, it really is ultimately their decision. But I'm going to say, hey, you know, are you going to be real comfortable with your rent right now is $1,500 and you want to buy a house and your payment's going to be $4,500?
Yeah.
You know, how's your savings really going to look like with that? I mean, if you got a big job promotion coming or something, that might be one thing. But I just don't want anybody to buy a house and then be in trouble in the
be
future.
house poor,
Yeah.
stuck, whatever that might be like.
I mean, back when I first got in the business, there'd be people that over in the mid cities would buy. I'm talking about maybe Grapevine, Gollyville, South Lake. There'd be these. That's where I initially was working, and there'd be people buy these huge homes, put everything into it, and then they'd have no furniture.
Yeah.
I mean, that's no way to live.
No.
Yeah.
I mean,
no. And I would say on the realtor side, having someone else that really cares about a person is just invaluable.
It's a teammate.
It's a team. I want
is.
someone that aligns with my values that I'm going to work with. And, you know, you have to be careful as a realtor to stay in your lane. I'm not licensed as a lender, so I have to my clients will ask me lending questions, and I'm like, I know a lot, but I'm not licensed. I need to stay in my lane. So I know that you're going to take care of them. I know you're going to answer their questions. You're never going to make them feel stupid. And the fact that you take that time to, like, I really want to get to know you. I care. Like, what's your kid's name, right? Like,
Right.
all of those things really matter. And so for me, when I'm teaming up with someone like you, the whole process is so much smoother, because I could be dealing with somebody that's not.
you have your own things to worry about,
right.
then have to worry about having to explain things, or, well, how does this work?
Or they didn't get back with me, and I tried to reach out. You know, that's
I
never
do hear
happened,
that
so.
a lot, and I hate
happens all the
that
time. It
because
happens all the
it's
time.
And you're trusted. Like, if somebody gets pre-qualified or pre-approved through you, I'm not going to sit over here going, well, I'm not sure, when I'm presenting an offer, which is very important. In especially like this summer market where you might be up against multiple offers, things like that. I want to know that when I'm saying, hey, my client is good to go, let's go.
right.
That I can put my yes behind that. And Mendy brings that to the table as well.
There's a lot of agents. I mean, it's kind of a trend, I would say, over the last several years, because I've been like before the housing crash of 2008. It's just a different market altogether. And I do get a lot of reach outs from listing agents about offers, asking me questions. And I think that's just indicative of the market, where people have not done everything so thoroughly. And, you know, it happens where, you know, you don't know if they've truly done everything thoroughly enough at the beginning. So
I had a recent situation where there was multiple offers. I needed to submit an offer. It was on the weekend. And I copy Mendy, and Mendy replies back immediately to the email. And so that listing agent feels comfortable going, well, there's these other offers, but, you know, also she said she texted you, and you texted her right back. So, like, those kind of things go a really long way, because the last thing you want as a seller's agent, is to go under contract and then the buyer's financing falls through. And things can happen.
Of course,
Life happens,
right?
but you can do your due diligence.
You do the best you can. And when I'm on the sell side, I'm always vetting. I'm calling the lender. And if I know that lender, I'm going to be telling the other side. I'm going to be telling my client, this one I can vouch for. They you know, it's good, right? So, all that to say, you're great at what you do, and I think it's very important in the whole process. So
Thank
huge.
you.
I mean,
Yeah, it
literally
if you don't
the
have
only-
the financing,
I mean,
you're
even-
not getting that.
Even before
Yeah.
you're looking at a house,
Yeah.
you need to know, can you afford it? Are you pre-qualified?
Yeah.
And so that's the first thing. The very first step is to talk to a lender,
Yeah.
and you want to talk to a good one. So
Well, and they're all different types. I mean, there's mortgage brokers, there's mortgage lenders, and I mean, they are different. I mean, for us at First United, we are bank based, but we still have a mortgage division, but we're servicing our loans. I mean, that means we're investing in our people
Yeah.
too, because
Right.
we're not just doing the loan, making the quick buck, passing it on to
outsourcing,
someone
right,
else. I
yeah.
mean, it's a long-term commitment. And I know that's what was at the heart of First United getting into the mortgage business, because when I first joined them 13 years ago, they were all over the Oklahoma market and they were kind of trickling down into northern Texas. And that was really what they got into it for, is because they wanted long-term commitment. They wanted actually to build a banking relationship with them too. That was a big deal to them. That was kind of their footprint they wanted. And they've been really successful with it. So anyways,
That's awesome.
I digress.
Well, let's dive in today.
Okay.
I would love to first just pick your brain on the current market. What are you sensing, feeling, seeing with rates? I mean, we can Google rates all day long.
Well,
But what are you seeing?
it seems like that they are softening some. They had so many predictions of what was going to happen this year. The first quarter, we're going to be golden, and it just never really came to fruition.
Yeah.
It just the market. There's just so many other factors in it. There's unemployment. And then there's whatever the Fed rate is doing, which a lot of people have the misconception that the Fed rate, they go, oh, the Fed's cut the rate or they raise the rate, and they think that that really is the mortgage rate. And it's really not. That's, bank loans, auto loans, things like that. But it does affect the mortgage side because the mortgage rates are tied to the bond market, and the bond market can react to those sorts of things. They just had a recent Fed meeting, and they basically said that they were going to sometime this year do a rate cut. And so that means that they feel like that inflation is slowing down. And that was really what was driving what they were doing as far as the Fed rates. And then, of course, all the other things trickling into the mortgage rates and affecting them. I mean, anything could happen. A war could break out, a foreign market could crash over the weekend, and then all of a sudden you see our markets react. So it is very, very hard to predict. So they're saying that they're going to do a rate cut later this year, and it should positively affect mortgage rates. Now, market-wise, I feel like that in the Metroplex, it's kind of a mixed bag. I mean, it depends on the location, because the Metroplex is huge. You have Dallas-Fort Worth, and I don't know if people that watch your podcast are all over the country, if they're just in Texas.
Hopefully both.
Yeah,
But
hopefully
who
both.
knows?
Hopefully. But in the Dallas-Fort Worth area, I have seen certain areas, there's a higher demand. Properties are going really quickly, multiple bids. I just had somebody last weekend that did something up in Argyle, and they actually overbid by $50,000. It was $1 million property, and they lost. And they overbid by $50,000, which I haven't seen that in a couple of years.
Yeah.
But then I have other people that are like south of Dallas Fort Worth, that a lot of those areas, I'm seeing properties sitting on the market a little bit longer. I mean, it's so hard to know. It really does depend on the area. But if the agent has it priced really competitively when they list it, I think that really goes a long way.
100%.
Yeah.
That's what
I think
I'm
the pricing
telling.
is huge.
That's what I'm telling my sellers right now. I'm like, you don't want to overprice right now. You really want to hit that sweet spot that's going to hopefully drive you to multiple offers. And it is a mixed bag. It's, I tell people, I'm like, well, it really depends on the area. And I think it's kind of always been like that.
Yeah.
But even going back to the Fed and like inflation, like you can't predict a global pandemic, right? We can't predict some of the things that have come our way. And I mean, I go to economic forecast meetings, and everybody kind of has their opinions and ideas, and you have data that you're looking at that you go off of, like, this is probably what's going to happen. But everything's so unique and individual. Cities are different. School districts, you have certain areas where the school districts were really great 5 years ago.
And now they're not.
And they're not anymore.
Yeah.
And it's like, oh, that used to be a really up and coming high, whatever area. and now it's kind of tanking a little bit. And so those all play into the market and the value of the home. So it's just it's all over the place. We were just
It is.
yeah.
It's
I'm
fascinating. It
I'm seeing
really
multiple
is.
offers.
Yeah.
I've also what I've seen is that we're currently more in a neutral market.
Yeah.
So
Yeah.
buyer's market, seller's market, and then neutral.
This is more normal.
Yeah, so it's like 0 to 3 months is kind of where the buyer's market is, and then 3 to 6 months, and then 6 to 9. And so right now but 3 months feels like a very long time.
It does, because
to sit on the
we're
market
spoiled,
because of where
2 days
we
on
were,
the market and
right.
it's gone.
And I
Yeah.
told people this, I was like, realtors have experienced massive whiplash because
Yeah.
everything was crazy, and then the Fed raised the rates and everything halted in so many ways. And there's people that have, they put their house on the market in October of 2023, and
They're homeless.
it was like, man, that was a rough time to list. So something's sitting on the market for, like, wow, this thing's been on the market for a while. I'm like, well, you have to look at the timing. You have to look at when they put that up there, what happened with the interest rates. Now you have the holidays, right? So every single house, it's a different story, different scenario. But I'm definitely seeing a little bit of all over the map. So when people ask me that question, like what's going on, I say I feel like it's normalizing and it's correcting. And
I would
it
agree
has
with
been.
that. Yeah.
Yeah.
I mean, I'd rather it be that way.
Yeah.
That's what we needed, but
Yes.
it comes with pain, right? I mean, I tell people, I'm like, 2.5% interest rate it's not really sustainable.
No.
Right? So
I'm
it's-
not sure we'll ever go back there, to be honest with
and
you.
I've been telling people too, I think what a lot of sellers are facing right now is, well, my house right now has a 2.5% interest rate. If I sell that, I'm going to make a bunch of money, but now I have to go somewhere. And
how much are you
what's
gonna have to
that rate going to
spend?
be? And you
Yeah.
really have to look at that. You really have to look at that. And then you also have to look at your life, livability, your stress levels, like your commute to work. Like, okay, are you going to get that 2.5% interest rate again? No. However, is it worth just sticking it out? Maybe. But also,
Or maybe
not.
turn it into a rental.
Right. There's a lot
That's
of
what
that
we did.
happening.
Yeah.
I loved turning ours into a rental. It hasn't necessarily been easy, but it's been worth it. Like,
Yeah.
I'm thankful for that. But not everybody would necessarily have the amount that you would need for the next house's down payment, things like that. So
Right.
there's so many factors.
Lots
I
of
was going to
factors.
say, I think what we're seeing too is a lot of buyers that are like, I'm waiting for the great rates. I even was talking to somebody the other day. I sent him your way. So I think you're in communication with him now. But he's like, I'm hoping that I'm going to wait for the rates to drop. And I looked at him. I said, I'm going to be honest. Could they drop? Sure. I said, are they going to drop a lot? I don't think so. Like, this is a very normal and healthy rate. Now,
Yes.
I understand that the house prices have gone up, so that makes the payments each month harder to swallow. So I don't mean to sit here and make light of the fact that these are normal rates, but they are normal rates. So I think we are seeing some buyers accept that
Yeah.
and go, okay, I need to get in. I need to get into the market because we aren't crashing, right? We were supposed to crash for about
Doomsday,
3 or 4
yeah.
years now.
Yeah.
And that's not happening, at least in our market, at least the local DFW market. It's a very healthy market.
We have very high employment levels.
Yes. And
Typically.
companies are moving in
Companies move to
constantly.
Texas.
Yes.
Yeah,
All
I
those
always
kind
tell
of-
people
Yeah.
DFW, our market is kind of, and I know, if you can't see my hands right now, I'm just going very slowly up and down, but it's an upward
A human
slope.
graph.
But
She's
you
a
do
human
have,
graph
you
right
do
now.
have your you do have your dips and
Yeah.
your rises, but it's not a peak in a valley. It's
Yeah.
not a mountain and a valley under there. We really do, and we go up.
Yeah,
We-
that
we-
2.5 that we all long for was an extreme because we were living in an extreme time.
Right, exactly.
It was. And honestly, I thought at some point, I kept thinking, are they going to get any lower? Because, I mean, they were so low.
Yeah.
And there is a bottom out. I did witness that, where
Yeah.
it didn't matter at some point if the bond market went any better because it just didn't go under
Where
a
did
certain
it bottom?
threshold.
Was it about that 2.5 or a little
I
bit
would say
lower?
close to 2.
Okay.
And I just think, but see, at some point, if you get even below 2, then why is anybody even doing mortgages? Why is anybody, gonna,
Right.
they're gonna lend you $500,000, they're gonna make 2%. There's probably something else they could do with those same funds and make money
right,
elsewhere. So
right.
at some point, it doesn't make them worth the businesses doing mortgages. I mean,
Right.
you got to be realistic about that.
Yeah.
Yeah.
I think a normal is, I mean, my gut is telling me, which, what is that? Magic 8 ball? Yes or no? Is this going to happen? I mean, that's kind of where we are.
Yeah.
I kind of feel like if they settle in the 5s eventually, that's going to be probably where
Healthy.
that's going to be
Great. Yeah.
a good time. But right now, you've got houses going and appreciating. They are appreciating.
Yeah.
That is something that I didn't really experience the first time I was in the business. I mean, somebody would buy a house for 100,000. I know, laugh. So we buy a house for 100,000, and then like 5 years later, it might be worth 105.
Right.
That was when I
Wow.
first got in the business, and that's just not happening now. Prices are appreciating, and that is going to continue to happen because, like what you said, people are coming to this area. They're relocating. Corporations are coming here. They're seeing the tax benefits, and people are coming here in droves, and we've got to have housing for them. And because of that, we really have a shortage of housing. It may not seem like
Right.
that, but I mean, you're going to see an influx of people coming in here, and they still have to live somewhere.
Right.
And so
I've
if
seen
you
an
buy a
influx
house,
of
it's going to
traffic.
continue. Oh,
I can
me
tell you
too.
that.
Great
much.
state of Texas, man. We.
I do not like the traffic.
Yeah.
It happened to me on the way here.
Oh yeah.
But
it's rough.
it's part of it.
Yeah.
But I do feel like that the if someone is buying a house now, they can hang their hat on that their prices are gradually going to appreciate. I just don't think we're ever going to get back to where you lose money on a house. I just don't think that our market is there. And
Yeah.
not that it's really as close as the California market was when I first got in, when California market was crazy. You'd buy something and you knew 20% appreciation in a year. That's not going to happen.
Yeah.
But it really
Which
never happened
actually,
in
I'm
Texas.
thankful for
Yeah.
because that's going to be tied to our property taxes,
lot.
things like
Yeah,
that. Like,
it
I'd rather
affects
have
everything.
a gradual.
Yeah.
Well, there's the downfall is that, as your house going up in value, then you definitely have to be aware that your taxes are going to go up, your insurance is going to go up.
All of it.
Yeah. So, but that's the thing when people ask me about payments, they're like, I want this payment. I'm like, okay, but you have to realize, and I get it, and it's great to budget for that. But what your payment is right now may not be what it is 10 years from now.
And half of it fluctuates.
Yeah.
The,
You
the
gotta be
principal and
prepared.
interest is fixed, but insurance and taxes change.
Yeah. I
remember on
and
the-
they can change drastically. I mean, insurance went up 55% or something crazy like
Yeah.
that. So that can change. You have to be ready for that.
Yeah, we're
Yeah.
paying quite a lot more on this house this year than we were the first year. I was like, okay, that's nice.
Yeah.
Well, I will say that in the last couple of months, I have seen a couple of very competitive insurance quotes. And I'm like, okay, does that just mean you've raised the deductible, or are you not going to pay claims? I mean, because there are a couple of companies that have
I
kind
think
of
it's
gotten real competitive.
Getting a bit healthier again.
it's
That was my
getting
understanding from when we
Yeah.
even did our other interview, is that we kind of went through a crazy year last year with insurance. And not that we're going to see anything dip massively,
Yeah.
which, I mean, that's how I feel about gas too. Anytime we get in the
Yes.
twos, I'm like, is it happening? Are we going back? When my mom and I first moved to Texas, I don't know how many years ago this is now, 22 years ago, gas was 94 cents.
I remember 74 cents.
Oh, bring it back. Bring
I
it back.
know.
We sound like those I remember when you could go
I
to see
know.
a
We
movie
just
for a
buy a loaf of
local
bread for
we
10
need rocking
cents.
chairs. A bag of popcorn for a penny, like my grandpa.
Wait, let me get
You're
my
like, I
glasses
didn't
on
have
so I can
shoes.
see.
Oh my
we're gonna
gosh.
have to do that.
Okay,
But yeah.
so I do want to say I often have buyers come to me, and one of the top questions is, are there any down payment assistance programs? And you and I were chatting about this. I just would love to get your insight here
Yeah.
on the down payment assistance programs and what does that actually mean? Because nothing's free, right?
Absolutely. That's what I tell people. And I
Mm-hmm.
do have a lot of people. That's actually a very, very common question. It's like, okay, times are tough.
Yeah.
Inflation's really affected our bottom line, and not everybody has, $100,000 sitting in the bank to go buy a house, but doesn't mean it's impossible to buy a house because you don't have all that money saved up. So the down payment assistance programs, there's several of them out there. Most of them, well, all of them have income limits, but they're within reason. They're, a household income, and I think it's
You
126.
can't be like a billionaire and
No,
get a down
you
payment
can't.
assistance.
But you don't necessarily have to be a first-time home buyer. So for
Oh.
somebody who doesn't really have a lot of funds, saved up, it could be a good option for them. Now, if they have money in the bank, it wouldn't be the first route I would go just because there are strings. Like you said, nothing is for free.
Right.
You're going to pay a higher interest rate for them. It could be a half to an entire point higher.
Yeah, see, I don't think people realize these things. It's
Yeah.
like,
And is that
okay,
a separate payment? Are you paying like a separate loan towards the down payment?
No, actually,
Portion it gets
all
wrapped?
of them, or most of them, are going to be a forgivable second lien with no payment.
Okay.
So basically, they set it up as a second lien, but then after 3 years, it's forgiven.
Okay.
So you don't have to pay it back if
Got
you
you.
stay in the house and don't refinance in the
But
first
you got a
3
higher
years.
rate.
and you have to stay in the
Yes.
house for 3 years, and that's important for people to know.
Yes.
Yeah, so if they're looking for that magic rate to show up
Yeah.
and they're at, 7.25, they have to wait it out those 3 years, or they do have to pay it back if they try to refinance or sell in that 3-year
Okay.
period.
And
to
that
know.
is something that I often will process with my buyers. Like, how long are you planning on
Yeah.
staying in this house? And I always encourage people, 3 to 5 years. 3 to
Yeah.
5 years. Now, you can, the capital gains tax is after 2. We won't get into all of that, but basically,
That should be a whole nother show.
it's a whole other, yeah, we can have a whole other podcast on that. But I'm always telling people to look at how long are you planning on staying. And some people are like, oh, some people think that they have to live in the house for 30 years. And I'm always like,
Yeah.
absolutely not. Most people don't. But some people just don't think through. And then when they think about a down payment assistance program, they don't realize,
They get kinda
there's
trapped.
rules. Yeah, there's
Yeah.
rules attached to this. And you just need to know what you're getting yourself into.
Yeah.
And it may be the best thing for you. Like, earlier it was like, well, if you don't have the cash,
Yeah.
this could be a really good option. You just need to know what you're getting into.
I would think too, my brain's sitting over here thinking of when it would be really good scenarios is if you know location wise where you're buying that there's healthy appreciation happening and you're going to be there for 3 years. That would be a best case scenario in my book because now you got yourself in the market. You didn't have the down payment. You had to pay a little bit more in percentage each month, but you got yourself in the market. You now have a little bit of equity and your house is appreciated. So when you
Yeah.
go to sell after those 3 years, you now have skin in the game on your own.
Yeah.
Yeah,
Absolutely.
I mean, it's a viable option, and it's certainly not something I want to discourage people from, but I just want them to have their eyes open about
aware.
it.
Well, yeah, because when you're saying the interest rate will be half a point to a point higher, it's not to say that would completely knock you out, but that's a factor to consider. Because
Yeah.
over those 3 years, how much money are you paying additional in interest?
Well, yeah, because, an amortization schedule, which I could get really crazy in that, but a basic amortization schedule is it's interest forward at the beginning
Yeah.
and then principal reducing towards the end.
Yeah.
So when you look at an amortization over 30 years, you've got most of the payment at the beginning is all going towards interest,
It's
and
very
then
depressing.
eventually it flips.
Okay, except for the
depressing.
fact that you get to deduct
Yeah, no,
the,
yeah, you can write it off. Yeah.
interest rate
Yeah.
Right.
on
Tax
On
deduction.
your taxes,
Yes.
it's a tax deduction.
Yes,
yeah.
thank you. Oh, we
Yeah,
didn't
you
get
know.
there.
You get
in
there.
my brain,
It's
I
what
was
happens.
like, yes, but which I don't think a lot of people know.
No,
honestly.
it's another thing. People are like, oh, there are definitely perks like that people don't think about.
It
but-
doesn't outweigh not being able to make a healthy payment. Like you've got to be able to make your payment each month. But I'm
Yeah.
just saying
Right.
at the end of the day, at the beginning, you can look at that as I'm giving this up. I'm paying towards the rate right now, the interest rate rather than the principal. But I get to write this off at the end of the year.
And what I see often is I see a buyer come in, first time home buyer. They're going to stay, that's why I always say that 3 to 5 years.
Yeah.
But, then they outgrow it. And then when they're going on for their house number 2, sometimes they're like, this will be like it for the next 10 years or the next, we want to settle here. We want to be in this school district. And I'm like, this is all really good to know when you're getting into the process, because if we don't really, this is just to get our foot in the door, and we're going to turn around and we really want to be in LA and we don't want to be here. And so we're going to move back in with family or whatever. You need to look at your timeline for
Yeah.
sure. Because it matters. And so I have clients that it's their second home. They're planning on being there for a long time, and we're paying a little, it was multiple offers. And I'm like, you're paying kind of over what I would necessarily recommend, but also you're going to be there for 10 years. It's the home that you love with the backyard of your
probably
dreams.
get it back at the end.
So it's like, give and take. Okay, well, you're not going to call me in 2 years to sell your house.
Yeah.
You're going to stay here for a while, and it all plays into it. So you have to think about timeline, location, like all of this matters.
It's huge.
But it's good to know that there are options out there for down payment assistance if you don't have the cash. And we've talked about this before. You can also ask the seller for cost concessions to go towards closing costs. That's going to help you out too.
Or like buy downs on rates.
Buying down the interest rate, but even also just like to go towards, you have less cash to come to the table with because the seller's giving you $15K.
Well, that is one thing about down payment assistance is you can't buy down the rate. The rate is what it is.
Yep.
So that is, you do kind of eliminate that option if you go with down payment assistance because the rate is what it is and you don't have like you lock it in.
But you could refinance after the 3 years.
Yes.
Now
yes.
are all down
payment assistance. We knew it. We knew it.
Guys, it's a Friday afternoon right now in my brain. Are all 3 years or are some programs different offerings?
The only ones that I've seen are 3 years.
Okay.
And we have, like I said, we have several of them. It's a viable option. You can choose 2, 3, 4, or 5%.
Okay.
I would recommend that you do at least 3% or higher because there's usually a little bit more closing cost with a down payment assistance program. So you're doing 2%, you're kind of paying a little bit of extra closing. It doesn't really help you all that much. But I've had somebody that got a gift, seller concessions, and down payment assistance, and out of pocket, which is Looney Tunes. They came with like $500. So
yeah, I just had one. We closed, and their closing cost was like $1,000. I was like, all right, well, that's great.
Yeah,
very
that's
rare, but great.
That's amazing.
Okay, one more thing before we land the plane. I know we're getting short on time, but I just basic 101 would love for you to just explain in a few sentences PMI, private mortgage insurance. Just break it down for a buyer. What is PMI? What does that mean? Why do we have it? And I know it might be opening up a can of worms, but
it's a big can of worms.
With that, how what should a buyer expect when they hear that word? Because it's something that people don't really, I feel, understand fully.
I feel like they also get scared, but it's typically not that much.
It kind of has a bad reputation, but I mean, honestly, it varies. So if you're not putting 20% down when you buy a home, or if you're going FHA, which some people have to go FHA, they're credit challenge or what have you, it's a little bit easier to qualify for FHA. But the mortgage insurance between conventional and FHA is different. With FHA, it's a fixed rate. You have a certain amount. They call it upfront financed. So there's a certain amount that's going to be paid upfront. It's going to be actually rolled into your loan amount. So instead of having a $100,000 loan, I know I laugh because $100,000. You're going to have that a higher loan amount that you're financing because you finance that into it. This is for FHA, and then you have a monthly amount. With conventional, you have a monthly amount that you pay every month. Now, if you're not putting 20% down, you do have to pay mortgage insurance. And it is sometimes tax deductible. I would refer to your tax advisor on that, but because I'm not a tax person. But it's usually based, if you're going conventional and you're putting less down and you have to pay it, it is an insurance policy that is paid if you default on the loan to your mortgage company. So not a lot of people like that because what's it benefiting me? I'm having to pay it. But that's the price you have to pay if you're not putting 20% down. Sometimes you can pay for it all up front in a lump sum at the beginning and not pay it monthly.
We did that. That's how you got us into this house.
Yeah,
so to make the payments work. And
it can be structured many different ways. It can be structured like part of the loan financed and then part of it monthly. You can pay all of it up front in a lump sum. It's paid for, it's done. And in most cases that's tax deductible as well.
Yeah.
Or you can do the monthly amount. But it is, if you're going conventional, it is driven by your credit score, how much you're putting down. But sometimes, it can only be like $40. It's not massive, but it's just people don't like it because they're having to pay it, and the beneficiary of that insurance policy is the mortgage company.
Yeah.
And then once you hit a certain place in the loan, it falls off.
Yeah, in conventional, it automatically drops off at a certain threshold.
It's 20%?
It's actually 78%.
78%.
It automatically
Okay.
does. But once you meet the 80%, you can actually reach out to your mortgage company
And
and,
that's
get
equity,
them.
correct?
Yes.
Okay.
And that's something that you have to reach out to them because they're, it's supposed to automatically fall off, but they're not watching that as closely.
Well,
as
it
you
will
should be.
automatically at 78%
At 78,
regardless.
yeah.
It's built into it. But now with FHA, if you're not, there's ways you can get around it. But for the most part, if you're going FHA, you're paying it for the life of the loan. It doesn't matter
Right.
how long or how much
30 years.
equity you have. So if you're going FHA, you might consider refinancing at some point just to get rid of your mortgage insurance. But if you put 10% down with FHA, it will eventually drop off at a certain threshold. So
lots of little hurdles.
there's so many
Yeah.
different little pieces
Well, I
to
think
it.
what I'm sensing is we need to do another podcast with Mendy to
Yes.
break down maybe even kind of the different types of loans and
Yeah.
like the benefits and the cons to each loan and why you would go one direction or the other. Because I know when I came to the table, again, on that first house, I keep bringing it back, but I thought FHA would be the best way to go because first time home buyer, you hear all these perks, things like that. And I remember you telling me like, no, conventional, like if you can, let's go conventional. And we did. And I'm thankful now learning all that I have about FHA. Great option if you need it.
Yeah.
But if you don't need it, it's not probably the best on the
It's
table.
the difference
so.
of a government-backed loan versus a bank-backed loan,
Yeah.
basically. And
Yeah.
it has lots of different caveats to it.
Well, the thing about FHA is it has a place in the market, and a lot of people buy with FHA. We could, like you said, we could go into tons of
Yeah.
it, but they're more forgiving if you have any dings on your credit. Also, your debt to income ratio, you can really push it quite high
Yeah.
with FHA. You're talking the difference between 50% or 55%, sometimes even 56%. We can always break that down at
Yeah.
another time, but
I think we should do that.
yeah, I think so too.
Let's do that.
So-
Well, I hate to end today, but we have come to the end of our time.
We've reached the end of the road.
The end of the
Well, we've covered
For
a lot of
today,
topics.
for Friday.
It's been fun.
yes, right?
Thank you so much, Mendy. Thank you for
Thank you
taking
for
the time,
having me.
coming out.
Yeah, we've loved having you. If people want to get in touch with you because they're like, man, I need to figure all this out, what's the best way to do that?
Okay, so I'm going to recommend reaching out to me by email. It's M, which is my first initial, Webster, just like the dictionary, at firstunitedbank.com. And first is spelled out. So it's pretty easy to get to me.
We'll also put that in the show notes.
Yeah, I've got social media. You can reach out to me that way. Mendy Twindy.
Mendy Twindy. It's my favorite.
Mendy Twindy on
Say it loud and proud.
Instagram.
Mendy Twindy on Instagram. Find
I have
me
to
here.
thank my aunt for that, but we will talk
love
about that
it.
another
I love
time.
it.
I love that.
That was my
thank
nickname
you.
with her.
So cute.
Cute.
Well, thank you again. We appreciate you.
You're so welcome.
Yes.
I enjoyed it.
And thank you to everybody out there.
Thanks for
We'll see you next
listening.
time.
Bye.
Bye.